I've less been here, but we started the Global High Yield Bond Fund in 2008 and been coming to Taiwan really almost every year for the last 12 years. So it was a little bit of a miss, but good to be back. And I would echo some of the same comments that one of the things about being back is this is the end of a 3-year period for normalization, not just of the pandemic, but of bonds, where we had the reset in treasury yields last year and it was painful, but we're basically back to where fixed income makes sense again from a total return perspective. We're at the end of the yield adjustments and central bank adjustments have mostly taken place, and we'll see that as we go through the market. But really, we'll talk a little bit about the different characteristics of the fixed income asset classes from investment grade all the way through to below investment grade. And basically, you're trading off duration risk or interest rate risk, and you're picking up additional yield and taking spread risk because there's more economic sensitivity in the below investment grade space. And so this is just looking at various fixed income asset classes, really decomposing the characteristics, looking at the volatility, the duration risk, and the yield that you're getting for that risk. And where my portfolios live is over on the far right-hand side, where we're getting relatively higher yields, less duration risk, and getting the highest yields that you really get per unit of volatility. And that's really going to be, I think, critically important as we go forward. We are picking up that extra yield now that we're through the adjustment that we've had with interest rates. We are back to a more normal environment and really exiting the extreme quantitative easing since the global financial crisis. It got even more extreme with the pandemic. So it's been really a rocky ride, certainly for the last 2 to 3 years, but we're exiting that and getting back to a more normal environment where everything just makes more sense again. And just to kind of pick up on that point, last year was a really weird year for fixed income, generally speaking. And when we see that, basically on this chart, we're looking at the return components for high yield, pulling it apart into the spread return component versus the duration component. And generally, they offset each other. So we've got the current yield that buffers some of the volatility, but in environments where spreads widen, interest rates usually fall and offset some of that, and conversely, in times when spreads are tightening in the asset class, interest rates will offset some of that, and they balance each other. Well, last year was the big outlier where we saw a little bit of drag on the total return from both the duration component and the spread component. The duration component, because of the adjustment in yields as we removed the massively accommodative fiscal and monetary policies, and also the move upward in yields as inflation started to pick up and shifted the curve much higher. That I'm happy to think is mostly normalized and is out, and we are back to a more normal operating environment where we think that you'll see the historic pattern of those two components offsetting each other and buffering each other in different economic environments will persist. So again, the normalization of the pandemic allows us to travel again, but it's also normalized yields to where these historic relationships we think will come back into play that have existed, really over the course of my career and kind of disappeared over the last 2 years. So, we'll talk a little bit about leaders, laggers, but the other thing to think about, is just with that throughout fixed income, there's different leaders and laggers every year. And they do switch places, and it just points out that to be dynamic in your asset class allocations and think less about the returns that persisted over the prior 12 to 24 months, and more think about the environment as we go forward. We do think that fixed income is going to be a favorite asset class next year. I think it's going to be. There was really no alternative from a return perspective, away from equities for the last 2 to 3 years. And again, part of the normalization, fixed income is going to be a very attractive substitute for a lot of different asset classes, and it's going to be quite attractive in its own right. So next we're going to talk a little bit more about the underlying fundamentals of the asset class, and really get more into expectations as we go forward and how we think the fixed income markets will fit into a portfolio overall. So I'm happy to report the below investment grade credit market, we're really coming into this environment from a position of strength. So while the pandemic was really painful, certainly for companies to go through, in my career, we do a lot of financial modeling and stressing of the companies in our universe, but it never dawned on us to assume that a quarter of our market would have their revenues go to zero for a year or two. And that was basically what the pandemic did, and caused us to look at things in a different way. It also really stressed the issuer base to really reconsider capital allocation policy and how they think about running their own businesses, and caused a lot of these companies that survived the pandemic to really reassess how they think about their debt balances. And because of that, you can see on the left-hand side here, we're going into the environment with some of the lowest leverage levels that we typically see. Usually companies during an economic cycle will try to run their balance sheet and as though the cycle's going to last forever, and they'll continue to lever up their balance sheets, and then we'll have an economic downturn, and the most levered companies will potentially have to find creative ways to deliver the balance sheet or potentially default, and then the whole cycle starts over again. And that's not what's happened this time, because we've had economic volatility really about every 3 years over the last 10. We obviously had the taper tantrum in the 2011-2013 period, which caused some spread volatility. We had our own issue in the U.S. We were around energy prices in the energy sector, 2015 to 2017, and then of course the pandemic caused another upset bout of volatility, and it really did two things. One, it cleaned out a lot of the companies that just frankly weren't viable, and the other is that the companies that were left just impressed upon them that perhaps it's not a good idea to run a very levered balance sheet throughout an economic cycle. And so debt leverage is really quite low, which I think is a really good indicator about how we think about stress going forward and future default rates. On the other side, you can see, again, the darker line really shows how much the debt levels have come down, just from a percentage basis on average. Companies have really cut the debt on the balance sheet. You'll see that again on the next slide. But the other on the light blue line, the cash flow generation ability of these companies, they're fully recovered from the pandemic. So I talked about that smaller proportion of the market, and I'm talking mainly travel, leisure, cruise lines, which all came to my market from Fallen Angel Land, as well as specific retail companies, and just the variety of businesses that I'm sure you're all familiar with that saw huge disruption from the pandemic. They're all back, and their earnings have all recovered back to 2019 levels. So again, we've went through this 3-year period, and everything is normalized. And for a below investment grade, portfolio manager, it's good news. So the companies are back, their earnings power is back, and their balance sheets, those that survived, are actually in much better shape. So we are entering a period of a little bit slower economic environment because of what central banks are doing from a position we think of strength. And just picking up on that theme, I'll address the average ratings, which I think is really important. The ratings in my world, it is still below investment grade, but the better part of the market, the double B part, continues to grow. So in the U.S. high yield markets, the majority of the issuers are double B rated, so the highest ratings category, and that's really good news. We've had a lot of issuers that have originally issued in our market, meaning came to our market specifically as double B issuers, and we've also inherited fallen angels from the investment grade market. And just because they're no longer triple B issuers, they're still double B issuers, and they're considered pretty high quality companies in our world. And that's good news. It's a majority double B market now, which is something that we haven't seen up until the last couple of years. But the other side of that is the triple C issuance, the really low rated stuff, the part where we get a lot of the default risk in the market, that's really shrunk, and it's really the smallest that it's been since the late 1990s. So triple C credit has shrunk from being about 18%, right around the financial crisis, to now it's about 10 to 11%. So it's a very small part of the market, which really I think is important as we think about potential default risk as we head into a slower economic environment. On the other side, the global credit markets in the below investment grade space, it continues to grow, and it's one of the largest, most liquid credit markets. So it's about 3.5 trillion. When we look at US, Europe, and the hard currency emerging market corporate space, it's really grown a lot from the financial crisis times. The financial crisis and the changes in bank regulations really encouraged banks to the big money center banks to push more risk off their balance sheets and into the capital markets, and that's really accounted for a lot of the growth. And then because as the market grew, became larger, became more liquid, it just became a self-perpetuating cycle to where the market continued to grow. And in the last 12 months, you can see the size of that fall a little bit, and that's really the companies voluntarily delevering their balance sheet. So the number of issuers, still the same. We continue to get more companies coming into our market to issue debt, but they've cut their debt balances, and that accounts for a little bit of the decline in the overall outstanding size of the market here recently. So again, debt leverage is extremely low. Our earnings have recovered from the pandemic, even though it's a large liquid market. We continue to see more double Bs, less triple Cs. So we're really coming into a period of potentially slower economic growth that's been engineered by central banks to remove some of the stimulus from COVID. So even as we slow, we're coming into this really from a position of strength. Now I talked a little bit about the lower ratings tier and why is that really important? Because we think about moving into an environment where central banks globally are removing accommodation and trying to slow the economy, trying to fight inflation. We really need to be much more cognizant of the default risk that exists in our market. And really thinking about that, investors like to talk about the default rate as though it's one number. And on the left-hand side, you can see where that is over time, but the default rate is really a phenomenon that exists in the lower ratings tier. On the other side, you can see the default rate for the different tiers. So the double B default rate is basically zero. I think it's 20 basis points on average. The single B default rate is really not much different. We get most of our defaults in that triple C ratings tier. And again, we're coming into this from a position of strength where the average credit quality is so much better that the triple Cs, that used to be 18% of our market are now 11% of our market. So, even if we get a pretty large proportion that moves in the triple C space in and of itself, because it's so much smaller, it's really not going to move the needle of the overall default rate of the market a great deal. Defaults in high yield, generally speaking, have moved up from about 0.5% to about 1.5%. We do expect that number is going to move up a little bit more as the economy slows, perhaps to 3-4%, about as high as it can get. That's really accounted for in current pricing, but as you can see, relative to history, it's really difficult for us to envision how we would get any type of spike even in a normal recession, which is not our base case. But the average credit quality is quite good. We're really not that worried about default risk, but we are cognizant that it exists, and we want to think about that in the way that we're positioning our portfolios. The reason we're thinking about that is because even though the economy looks like it's in pretty good shape, it's clearly slowing. The bottom chart really looks at coincident and lagging indicators. So coincident, lagging indicators, things like business inventories and wage pressures. Coincident indicators would be things like the unemployment rate, things that are indicating how the economy is performing in real time. Those indicate that the economy is actually doing pretty well. But the top chart, we look at the leading indicators, we look at purchasing managers indexes, and those indicators that really give you, that historically have indicated where the economy is going in the next 6 to 12 months. Those are clearly slowing down. That's not a surprise. Central banks are trying to engineer that slowing on purpose to combat inflation globally. And so it's not a question of is the economy slowing, it's how much is it slowing and how much we need to be concerned about it as we think about our portfolios. particularly in the below investment grade credit space. We need to be really attuned to this so that we can think about metering risk in the portfolios. We want to maintain an appropriate risk posture, one that's generating the highest current yield that we can for our investors, but not one that's so high that we are taking undue risks and have potential negative experiences from a credit risk perspective. And so that's the way that we're thinking right now. As we look, as we kind of look at where we are, look in the rearview mirror where we've been, the economy looks pretty good. As we look forward, things are slowing, and we just need to be prepared for that, even though we are coming into this from a position of financial strength. And so when we think about this, how do we think about the sequencing of an economy as the economy slows down? When we think about, again, that first slide I put up, we think about the spread duration risk versus the interest rate risk of everything that we buy in our portfolios. The credit, the spread being that yield premium that we're getting over treasuries versus what we think treasuries will do. The two of them being the total yield of our investments. How do we want to think about, those two components as they move through the portfolio? So the first chart shows you what treasury rates do around economic slowdowns, and treasury rates usually top out right as the economy is slowing down, which is probably sometime around now to the next 3 to 4 months. And it indicates historically, treasury rates top out right around, pretty much at the same time that the economy slows down. So even though interest rates were a pretty big drag on returns last year, you're getting paid for taking duration risk at this point, and we're not really concerned about the duration risk component of the portfolio. More so on the other side, really using equities as a proxy, how to think about credit spreads. What should credit spreads do around an economic slowdown? And looking at equities, so this is looking at the S&P 500 with a 6-month lag versus economic slowdowns. Risk assets usually bottom about 6 months after the slowdown starts. So, thinking of this as equities, but we're about 60% correlated with equities in the below investment grade credit space. That indicates that we don't think there's a lot of fundamental risk in the market, but we do think spreads will be range bound. And while we want to make sure that we're getting paid appropriately and our investors are getting appropriately compensated for the risk in the portfolios, we want to be cognizant that we don't take too much risk, because we might have an opportunity to buy things cheaper later this year as the economy slows. And so it's really balancing those two. So thinking about interest rate risk, that's probably over. The yields have likely peaked here. Spreads, spreads look pretty decent to us right now, but they're probably going to get cheaper before they get richer again. And so it pays us to think about the risk in the portfolio, and then you leave a little bit of a bucket for us to buy things cheaper later, while maintaining a yield that's as high as we can get it without taking undue risks right now. Now, I talked earlier about, and Vlad did as well, fixed income as part of the portfolio. What's the return outlook for the asset classes, and not just below investment grade, not just preferreds, but really all asset classes. And this picks up all asset classes, fixed income, equities, alternatives, and we want to look at them holistically. Where are you getting the most return per unit of volatility? So the vertical axis is returns, the horizontal, volatility. And this is put together by an asset allocation team at the firm that interviews all the specialist portfolio managers, myself, Vlad, and all the portfolio managers across the different asset classes. And they use our inputs into a quantitative model to try to figure out the answer to this question. And what's really interesting about the way that this curve looks now versus the way that it looked a couple of years ago is now the yields have reset. The fixed income actually looks pretty good on a Sharpe ratio basis. So really the returns are all bracketed between about 7 and 9%. But as you go shift that out to the left, into the equity asset classes, you're getting pretty similar returns, but at about 2 to 3 times the potential volatility of the investment. To our mind, this favors fixed income over equities. Really up until last year, there was no alternative but equities if you wanted to get returns in a portfolio. But now that we've had the rate reset, and where fixed income is relative to equities, fixed income looks like a better value. Certainly as we go into a little bit of a slower economy, where you've got, with equities, you need prices to go up. With fixed income, you're flipping a big coupon, you just need prices not to go down. And this seems like a good environment for that. So fixed income is basically favored over equities to our view. Within fixed income, choose your risk profile. You're getting 6 to 7% investment grade credit, probably 7 to 9 and below investment grade credit, and you're getting both at significantly lower volatility than you are in equity asset classes. So we like fixed income versus equities as opposed to the investment grade versus non-investment grade. There's merits to both. It's just a function of your thoughts on the economy and your thoughts on potential volatility and scaling into your investment over time. And again, the reason that all this is good is, the yields are high again. Yields are back to where they were over the, we haven't seen yields like this for 10 years. And it's really goes back to the reset in treasury rates. And the central banks have been trying to generate inflation really for over 10 years. They've finally been successful. And now they're taking away the accommodative policies. And we finally had a 25-year bull market in bonds reverse itself, and it reset treasury rates to levels that we haven't seen in quite some time. And that's made the overall yield in my world look great, look good again. I mean, the yield in our portfolios now is around 8.5%. And the dispersion of yields is anywhere from 6% to 12%, and we can choose our risk tolerance, and we can build out a portfolio that's got moderate risk at very attractive overall yields, and really set up to buffer itself from any type of reasonable volatility that we expect in the markets as we go forward. So really, this reversal in yield is really what's made all the fixed income asset classes on the prior slide look attractive, certainly in and of themselves, but certainly against other asset classes as well. Now, in my portfolios, it's a truly global portfolio. The anchor of the portfolio is the U.S. The U.S. high yield markets are the largest part of the global below investment grade credit space. And it's one of the deeper markets, and it's always going to be the core of the portfolio. But there are other markets that we think look attractive too. The European high yield markets typically are a little bit higher rated than the U.S. high yield markets, a little smaller, a little less liquid, and have historically traded equal to or less yield than U.S. But because of the economic stresses in Europe, the European high yield market's actually cheaper than the U.S. high yield market. There's good reasons for that. That's probably going to be the economy that feels the most recessionary pressures, particularly in the United Kingdom. Brexit's not wearing well. There's a variety of stresses going on there. And that market, we can get 10 to 12% yield in a lot of sterling bonds. But it's a market that looks attractive to us, and it's a market we've been underweight for 5 years. We're still underweighted, but we will take targeted shots there. And it's something where I expect we'll be less underweight as we go forward. Emerging markets on the other side generally does trade cheap to U.S. markets, but it's somewhere that looks kind of interesting now. The emerging markets, there's basically 3: Latin America, Eastern Europe, and Asia. But Latin America looks like a really good value to us, where we're getting double B and triple B securities at spreads that are similar to what we can get in the U.S. and single B and double B securities. Eastern Europe, we've been underweight that and will continue to be. Asia, there's not a lot for us to think about in the below investment grade space. It's predominantly an investment grade market, but we've been overweight the China property companies for the better part of a year, and while it's been a little bit of a tough ride from time to time, we are finally starting to see good returns there, and it's an area that we will continue to have risk in the portfolios. But it's truly a global asset class. We like an EM. We're continuing to buy EM. Europe, there'll be a time for it. In the U.S., there's always good opportunities across many sectors. The COVID reopening theme, we continue to have exposure there. We have a decent position in really the lodging, leisure, cruise line, airlines, still things that we bought at very cheap levels, secured, meaning that we actually have a hard asset collateral. With a lot of these are yielded anywhere from 10 to 12% at the time. They're a little bit inside that now, but still look like good value to us. And so our expectations, we build this out, just the math of where we think total returns could be in a variety of cases. We use this partially as a forecast, but also just as an orientation point. Below investment grade credit is the spread over the treasuries is going to be a proxy to price for future default risk. And so when we think about how we think about this, we'll make some basic assumptions on where we think yields will be on the treasury market, as well as do a bottom-up build of what we think a reasonable default assumption will be. Because triple Cs are so much lower, we do think that it's tough for us to envision a moderately slower economic scenario where default rates would really get much above 3%. And so in our central case, you can see this. Because the current yield's back, the current yield's high, it buffers a lot of the volatility. But even if we use a 3% default rate assumption, which is double what it is right now, we still come up with a 7 to 8% total return on a forward-looking basis, predominantly through coupon carry. The other thing is, as a fixed income investor, we're always thinking about downside, more so than we are about upside. And the really nice thing is in the downside case, where we get a more, even if we stress the default rate, move it up to 6%, it moves spreads out to 700 basis points over treasuries, which is 250 basis points wider than they are currently. The drawdown is low single digits, 3%. Again, because the yields have reset, because the coupon is so high that buffers a lot of that volatility. And so in a base case, we see high single-digit returns. It's tough for us to get that exercised or that excited about the downside case, and there is potential upside from both of those. So again, going back to why we think it's attractive, or why we think it fits into the portfolio, we think it's going to be pretty good in and of itself. I think it's going to look really good against equities. We do expect some spread volatility this year. I would tend to think of credit spreads as being range bound, as I talked about in our portfolios. We want to be, we're fine taking some risk in the portfolios. We're currently, have about, a 0.95 beta, but we want to leave a little bit so that we can add risk later at cheaper levels. We do think we'll get a chance at that. We do think the economy is going to slow a bit, but it's not anything where we think it slows so much that we're really that concerned about default risk. So we really think it's an attractive place to invest. We think it's going to look good versus a variety of other asset classes, and we're coming at it from a position of strength. So again, it's good to see y'all. Hopefully they can translate y'all. I am from Texas. But appreciate your attention and look forward to your questions. Thanks.